pretty good. Sometimes
Going down. All right. Back to cover calls. So you have 100 shares of Amazon. Investment 150,000. Price $14.95. Cover call. We're gonna do it every month for a premium. And this is May. This is March. So next month is April. So we're gonna write. What do we say? Give me a strike, Artem.
1460.
That's for the put.
Oh,
We're gonna go higher for the cover call now. I want share growth.
1510 or 1515.
Okay, that is 1520.
Okay.
1520. Strike. Right? So we're gonna allow ourselves to get share growth 25 points. See that? So that's 2,500, which is decent. Then after that, we're gonna give it up. We're gonna take our premium, and in this case, in April, they're paying 48 by 51. Let's just say 48. I wanna make that greedy. You can put the sell price in between 48 and 51, let's say 50, and get it, but you do that market, it'll be 48. So 48 is $48 a share. 4,800 for 100 shares, right? That's one contract. And then if you do the math, we're getting $4,800 divided by 100, 49,500, 3.21% return, which is excellent, right? Times 10 months, 32%, 0.1% return, right? So if we're getting 48 points, collecting that for a cover call every month, our share price, what happens, if we look at it this way, it comes down by 48 points. 1447. Okay, that's our cost. Think of it that way. Okay? Now meanwhile, we're going to have this cash in hand. We use it to write checks, pay bills, buy more shares, leave it there. But that's, your account's going to increase by that, by the expiration. And our cost, if you put it to your cost, it goes down to 1447. So let's do this for 10 months. We're going to get 480 points off of here. Okay? 1495 minus 480. It's about the same every month. It might go down or up, and it'll go up when the market's rich. So this might go down to 40. And it might go down when the market's kind of just weak and laggy. It might go down to 30. It might go up to 50 or 60. But it can go down, let's say, to 40 or 35. Right now it's 48, so we're happy. And our cost after 1 year of 10 months of doing it, take 2 months off, I always teach that, is going to be $1,015 a share. So we came in with $1,500 a share, and now our cost comes down to $1,000 after a year doing cover calls. And then year 2, here's the magic, 535 minus 480. We were getting 50 points for writing the other strike, the 1510 or more. And then year 3, your cost is down to $55. Here's where the magic happens. You're getting a good stock, hopefully in a good market, and you write cover calls every month. You're getting 50 points a month, 48 points. It's lowering your cost, and you can get to the point after year 3 where the whole stock is paid for. So the first month, 48, it's going to be 7 points left, and then by month 2. So it's 3 years, 2 months. You're in positive territory. Your whole stock is paid for, and your investment becomes a cash cow because you already have your 100 shares sitting there, writing cover calls, right? So now it's a cash cow. Now you're making, your whole stock's paid for. The market can crash, the stock can go down, and you lose, but you don't really lose because you have all this premium every month, $4,800 every month. And it's just all green. And that's the plan, that's the long-term plan for a covered call position, where it could take you anywhere between 3 and 6 years to pay your stock off and your investment become a cash cow. So now the covered call turns to cash cow. That's the point. You want to do Twitter? And
Yeah.
we'll see another example. Twitter's a little bit better, but with Twitter, you're spending less money, but it's higher risk because it's not really even profitable, Twitter, but it's in favor. People are still tweeting.
How's Netflix look on cover call?
What did Netflix instead?
Sure.
It's even better than Amazon. See Netflix. Cover call, right? So the share price is 300 for Friday. It was down. 300 times 100 shares. 30,000. Right? Investment. We're in March, so we're right to April. Now, if the stock is, say you get in now, the stock at 300, right? You want to allow for some share growth. So what do you want to write to strike at? What do you want to write the cover call? You want to allow for some share growth.
I don't know, 220?
I'll let you choose. 310 pays 1440. 320, you can go 315 pays 1240.
All right, let's try that.
315?
Yeah.
315 strike. Cover call. Right? It's paying 1240 by 1275. You want to try to go in between?
Yeah, it's just going in the middle.
1250. Make a limit order to sell the 1315 strike, 315 strike for April at 1250. And they'll take it. It might take 30 minutes. At the market, it's 1240. You save yourself $100. All right. So now we're going to get this 1250 and multiplied by 100 shares is $1,200. 1250 income a month, right? On a $300 stock. So what do we do the math on that? 1250 divided by 30,000. 4.16% return. 4.166, 4.17% return. A month, right? And we do it 10 months, we take 2 months off, 41.7% return a year, right? So at $100,000, this is you're gonna get 41,000 on the cover call, and that's leaving 15 points share growth, so it can be more. It could be less too, but we'll get that in a second. So now, another way to look at it is we're gonna get 1250 every month, which is gonna reduce our cost of 300. So after 10 months in the first year, that's 300 minus 125. The first year, our price comes down to 195 from 300. 1 year cover calls. And then again, 125. $70. Year 2, your cost is $70 on Netflix. You're getting $12.50 a month. You're getting 4% a month and 41% a year. And then by year 3,
$35 or something?
you're in positive territory after 3 years. about 2.5 years, you're paid for, your stock's paid for. It becomes a cash cow. So the value here is you're going to get $1,250 a month on 100 shares, 30,000 investment, or 1,250 points per share, 4% return a month, income, cash in hand, lowering your costs. By year 2.5, you're going to be at paid for, and it's just generating money. And that's the plan. So this is 2.8%, this is 4.7%. The risk here is that Netflix can move a lot more than Amazon. They're both about the same PE, 200 something, 250, which is very high. But like I said, I like to do stocks in favor. So these are both in favor. This is the boss, this is like a little boss. Want to cut that, Chris?
Yeah.